When safety became an illusion, it felt secure, engineered to prevent disaster, designed to remove fear from finance. Losses were smaller, failures were rarer, and the system appeared calmer than ever before. Yet beneath that calm, safety itself was quietly changing shape. To understand why perceived safety became dangerous, we need to look at how protection evolved after earlier crises. Rules tightened, capital requirements rose, safeguards multiplied across institutions. Each reform aimed to eliminate uncertainty, replacing judgment with structure. Over time, stability stopped being something to earn. It became something to expect. As confidence grew, behavior shifted. Banks relied more heavily on models that promised precision. Risk was sliced, rated, and redistributed until it appeared contained. Insurance against failure expanded. The belief took hold that shocks could be absorbed without lasting damage. Safety became embedded not just in policy, but in mindset. This transformation altered incentives. When protection feels reliable, caution feels optional. Institutions expanded exposure within permitted boundaries, trusting that buffers would hold. Investors accepted lower returns in exchange for perceived certainty. Policymakers pointed to safeguards as proof that the system could endure almost anything. But safety defined too narrowly creates blind spots. Models assume correlations will break. Liquidity is expected to remain available. Protections are designed for familiar stress, not behavioral surprise. As long as conditions remain normal, these assumptions appear justified. Early warnings were subtle. Markets reacted more sharply to minor disruptions. Correlations rose faster than expected. Liquidity thinned in places once considered safe. Each signal was explainable. None seemed urgent. Safety still felt intact. This was illusion taking shape. Stability was no longer rooted in adaptability, but in belief. The system trusted its defenses more than its understanding of risk. And the more those defenses succeeded in calm periods, the harder it became to imagine conditions they could not handle. When safety becomes assumed rather than questioned, it stops protecting. It encourages alignment, leverage, and dependence on mechanisms that only work under specific conditions. And that is how the pursuit of safety quietly transforms into one of the system's greatest vulnerabilities. As the illusion of safety settled in, it began reshaping how risk was treated across the system. Protection was no longer viewed as a backstop, but as a foundation. Decisions assumed safeguards would absorb shocks before they reached critical levels. The margin for error narrowed quietly, not because risk increased recklessly, but because confidence replaced caution. Institutions optimized around this belief. Balance sheets were structured to perform well under regulated stress, not to withstand unfamiliar pressure. Risk managers focus on compliance with protective frameworks, trusting that anything permitted was therefore manageable. Exposure accumulated inside approved boundaries, where it felt justified and controlled. Markets reinforced the pattern. Assets labeled safe attracted enormous demand. Yields compressed. Investors crowded into similar positions, confident that protections would prevent extreme outcomes. Safety became a trade, not a condition, price, package, and assumed to be reliable regardless of scale. But protection changes behavior in predictable ways. When downside feels limited, alignment increases. Diversification weakens as participants chase the same reassurance. Risk does not vanish. It concentrates behind the same defenses. The system grows calmer on the surface while becoming more fragile underneath. Regulators observed stability and saw confirmation. Stress indicators remained subdued. Interventions proved effective. Each success reinforced a belief that the framework was working as intended, yet the success masked a deeper shift. Safety was no longer dynamic. It was static, tied to rules rather than awareness. Early signs of distortion appeared during minor shocks. Assets meant to behave independently moved together. Liquidity hesitated and markets built around confidence. Small disruptions required outsized reassurance. Each incident was resolved, but at the cost of deeper reliance on protection. Inside institutions, questioning safeguards became difficult. Doubt felt unnecessary, even disruptive. The system rewarded trust and structure over curiosity about its limits. The more safety was demonstrated, the less it was examined. This was the quiet escalation. A system built to prevent collapse began encouraging behavior that made collapse more likely under the wrong conditions. Safety had succeeded so well that it reshaped incentives in ways few anticipated. And once safety becomes something everyone depends on, it stops being a shield and starts becoming a single point of failure. The conflict emerges when conditions challenge the assumptions behind protection. A shock arrives that is not extreme enough to trigger safeguards, yet disruptive enough to test behavior. Models remain calm, but markets react sharply. The system feels safe on paper, but unstable in motion. Institutions confront contradictions. Metrics signal resilience, while liquidity tightens unexpectedly. Buffers exist, but confidence erodes faster than capital. Risk controls behavior as designed, yet outcomes diverge from expectations. Safety mechanisms hold, but they do not reassure. Markets amplify the tension. Assets once considered havens move in unison. Correlations spike as participants seek the same protection simultaneously. Liquidity thins not because safeguards failed, but because behavior aligned around them. The very presence of safety accelerates retreat when doubt appears. Regulators face a narrowing window, intervening risks reinforcing dependence, waiting risks allowing uncertainty to spread. Each option carries cost. The system no longer responds proportionally. It responds reflexively, shaped by assumptions that safety will be provided if needed. Public perception shifts subtly. Trust weakens without dramatic loss. Confusion replaces confidence. If the system is protected, why does it feel fragile? The gap between reassurance and experience widens, eroding belief in safeguards that once felt unquestionable. Inside institutions, awareness grows quietly. Safety mechanisms reduce certain risks, but amplify others. Protection against collapse encourages exposure to alignment. Preparedness for known shocks leaves little room for surprise. The system has traded resilience for reassurance. The conflict reaches its peak not during failure, but during doubt, when participants no longer know whether safety will arrive and whether it can handle collective behavior shaped by reliance on it. This is a paradox. The more safety is promised, the more damaging its limits become when tested. And when belief in protection begins to waver, the system must confront what safety can and cannot do. Because safety that works only under specific conditions is not safety at all. It is stability on borrowed confidence. The reckoning arrives when the system accepts a difficult truth. Safety mechanisms did not fail. They worked exactly as designed. What failed was a belief that protection could replace awareness, and that structure alone could guarantee stability. In the aftermath, the conversation changes. Policymakers begin shifting focus from preventing specific failures to understanding collective behavior. Safeguards remain, but they are no longer treated as final answers. Stress testing expands beyond balance sheets into liquidity dynamics and behavioral response. Silence in the indicators becomes a reason to investigate, not relax. Institutions adjust more cautiously. Capital and buffers are still valued, but so is flexibility. Risk culture broadens from compliance to curiosity. Managers begin asking not only whether exposures are allowed, but how they might behave when everyone reacts at once. Preparedness becomes less about certainty and more about adaptability. Markets respond unevenly. Some confidence returns. Some assumptions fade. Assets once priced purely for safety are reevaluated for their behavior under stress. Diversification regains meaning as alignment is recognized as risk. Stability becomes something earned through resilience, not assumed through protection. For the public, trust rebuilds slowly, not because the system promises perfect safety, but because it becomes more honest about its limits. Transparency replaces reassurance. Understanding replaces illusion. The system feels less comforting, but more credible. Looking back, the illusion of safety reveals a timeless lesson. Protection can reduce damage, but it cannot remove uncertainty. When safety is treated as a substitute for judgment, it quietly reshapes behavior in dangerous ways. True resilience does not come from believing failure is impossible. It comes from accepting that uncertainty is permanent and designing systems that remain stable even when belief gives way to doubt. Because the moment safety is no longer questioned is the moment it becomes most dangerous. Subscribe to join the journey. When